Okay, so it looks like people are still gathering, but we'll go ahead and begin. Thank you all for joining the webinar today. We are looking forward to today's discussion. We're going to be discussing LP investing in a COVID world, and I know we've talked about COVID for a while now, but you can't really do a webinar without talking about it. So bear with us. We're going to talk about how the mindset of the LP has shifted, what was, what is, where we're going, how the election has affected things. So looking forward to that. Before we do, as we shift to the next slide here, for those of you who don't know who I am, my name is Lena Dobrier. I'm the Director of Operations at Opus Connect. We are a lower, middle, and middle market M&A focused organization. We cater to transactional professionals, private equity firms, investment bankers, independent sponsors, family offices, and typically we would be in each one of our main chapters, LA, Chicago, and New York, once a month doing a panel or a roundtable. Of course, now we're doing it virtually. And in addition to those monthly seminars, we also do deal sourcing events in various markets. Of course, again, everything is virtual. But we pair up, capital providers and investment bankers and GPs and LPs as we're doing today for one-on-one meetings. So if you're interested in learning a bit more about what we do and how we can help, please feel free to reach out to my colleague, Jacob Zeffrin. His contact information is below. He'd be happy to answer any questions you might have. Let's shift to the next slide here, please. Today, you'll be able to submit your Q&A in the Q&A box below. So as we move through the discussion and questions pop in your mind, please feel free to submit your questions there. Please do not use the chat box, but use that designated Q&A spot. Our moderator, Richard, will be looking through those, and we'll try to get to as many as we can. These events, of course, would not be possible without the support of our sponsors. So we'll shift to the next slide here, and I just want to quickly acknowledge Focus Search Partners. They're unable to attend today's event, so you won't be hearing from them now, but you will be hearing from them later. Executive Search Fund for PE, I'm sorry, not a fund, Executive Search for private equity firms. A little bit more about them here. If you want to reach out to them or learn more, please contact Steve Finder. And then, of course, Sadis. Richard Shamos is going to be moderating today, so we'll wait until we introduce him so he can introduce the firm. But if we weren't virtual, we'd be at their law offices, so we definitely want to acknowledge them. And we'll move to the next slide here. We do have a quick poll question that we'd like you to participate in. This will get us, give us a good idea of who you are, who's in the audience. So I'm going to go ahead and launch it here. Please submit your response. We'll give it about a minute, and we'll share the results, and then we'll move on. We do have a GP LP meetings event with one-on-one meetings today after. So I assume many of you are in the room today, but just let us know who you are and we'll move through that quickly. Give it about 15 seconds here, and then we will begin. Okay, so looks like 29% independent sponsor, 24% investment banker, some capital providers on the debt and equity side, of course, good chunk of LPs. Awesome. Thank you guys for participating in that. Without further ado, let's shift to the next slide. I want to introduce today's moderator, Richard Shamos of Sadis and Goldberg. Richard, take it away, sir.
Thank you, Lena. Thanks for that wonderful introduction. And thank you to all of my panelists for joining as well. My name is Richard Shamos. I'm an attorney at Sadis and Goldberg based in New York. We are a law firm specializing in alternatives and specifically on the private side of alternatives. I'm a fund formation attorney, so we handle everything from hedge funds to private equity, real estate, infrastructure funds, and we've got a pretty kind of funky specialty finance practice as well. So very excited to be chatting with you about some of the developments that we're seeing in the market and sort of discussing where we think things are going to be going in the future. We have 3 distinguished panelists here today. I'll just briefly introduce all 3 of them and let them give an introduction of themselves as well. So we have Kurt King, who is the Chief Investment Officer of the King Family Office, Andriy, Vice President of Co-Investments at Capital Dynamics, and Amir Aviv, Managing Partner of Gatewood Capital Partners. So I'll hand it over to Kurt. Kurt, why don't you say a few words and tell people what you do, and we'll start getting things moving.
Thanks, Richard. My background includes 20 years as a professional technology investor, primarily as a long-short equity manager out of San Francisco, and prior to that, as an analyst both on the buy side and the sell side. Wrapped up the hedge fund career at the beginning of 2017. Since then, I've been investing exclusively in a family office format. What we do is a combination of direct investments in tech companies, usually special situations with an activist angle, and LP investments in a combination of tech-related funds and lower middle market funds, typically buyout related, across a sector of industries. Right now we have, I believe, 16 active investments, 3 direct, 13 LP. And I relocated from San Francisco to New York in 2018.
Great, thank you, Kurt. So Andriy?
Hello, everyone. Excited to be here. Andriy, FITSYCH, focus on co-investments at Capital Dynamics. I've been here for about 4 years. Prior to this, I was at Stepstone doing the same. So Capital Dynamics, it's a global asset manager. We have about over 17 billion of assets split across clean energy infrastructure and private equity. Private equity accounts for about 12 billion. It has four verticals: co-investment, secondaries, fund of funds, or primaries, and a direct lending business. All 4 of them focus only on mid-market. We define mid-market as companies less than $1 billion in enterprise value. Also, each strategy has a dedicated team, a dedicated pool of capital, either in the form of fund or separately managed account. This construct allows us to be efficient and quick how we execute, as well as to be a kind of reliable partner and able to invest across cycles. So on the co-investment side, we deployed Fund 4. It's about $400 million vehicle. We made 22 investments. We are fundraising Fund 5, which has a target size of 400 million. Pretty good fundraise traction. We raised over 50% of the fund through COVID. I mean, obviously, it's a sector agnostic strategy. We're not specialists. And we're looking to partner specialized mid-market, lower middle market sponsors on a global basis.
Great, thanks, Andriy. And Amir?
Sure, happy to join everybody. My name is Amir Aviv. I'm a managing partner in Gatewood Capital Partners. We are a private equity fund, and we are focused on anchoring emerging managers. And emerging managers, pretty much across the board. We don't do really early stage VC, but other than that, we do both private credit, buyouts, real estate. We have 11 funds at the moment in our portfolio. We'd like to write commitments of between, our sweet spot is $20 to $40 million, and our funds range from 200 to $500 million. Happy to join everybody in this discussion.
Excellent. So thank you, gentlemen. Why don't we, we'll kick it off then. So, you know, obviously it's a very interesting time in the world right now. You know, I would say November in some ways feels a little bit like April did as far as COVID is concerned, with the numbers rising and more talk about lockdowns, but in many ways it also feels very different. And I think we'll see that continue to play out in the private investment space. So the first question that we have here for our panelists, and maybe Kurt, I'll start with you, is, you know, just how has the private investment market changed for you over the course of the past 6 months? And how do you see it changing in the future? And in particular, we're kind of looking at some of the pipes and plumbing, if you will, of the market as far as, you know, operations, due diligence, meetings, how are you sourcing deals and things like that? You know, how are you seeing changes?
Right. Well, first of all, in terms of the investment environment, a couple of things. First, the appetite for growth has increased dramatically as the world at large has slowed down, and we're seeing unprecedented multiples in the tech companies that I look at where there are attractive organic growth stories. On the flip side, among the lower middle market companies, the private ones that we're also interested in, they much more so than the big companies. I mean, they found COVID to be a stressful event for them, not just because of demand falling off, but because they simply lack the systems and the infrastructure to deal with the demands of things like work at home and having customers delinquent on billings, et cetera. So while I think the bar is higher among high growth companies due to valuation, I think the opportunity set is a lot more attractive among these smaller companies that are harder to find. But I think upon reopening are where the real returns can be generated at this point. Now, part of the challenge for me as an investor in this environment is that because I'm focused on emerging managers, my process doesn't work so well because so much of what I do is dependent on face-to-face interaction with managers, given the absence of traditional data, namely long track records that I can look at from anywhere. So my focus as an investor really has been on my existing investments, including co-investments, where additional capital is needed. I'm really looking forward to that changing, but we got a little bit of wood to chop.
So just to kind of follow up a little bit on that, I mean, obviously multiples are extremely high in the market right now. Has that shifted your behavior? I mean, how do you see that playing out in the coming 6-12 months over the course of 2021?
Well, in terms of the multiples, I mean, barring any real surprises, we're likely to see some sort of mean reversion, where multiples on growth are at unprecedented levels, is most obviously in the public markets. Whereas, while the other end of the continuum value, it's seen some improvement since the vaccine news has happened. There's still, historic level disparities there. I would expect that as visibility to more normalcy returns, we're going to see continued reversion to the mean there. Now, for me, most of my activity has been tied to my LP investments, where there isn't really a valuation number that you can put on anything. It's really just a question of how large is the opportunity set for the general partners, and how good of an entry point can they find on deals. And I would say, I'd have to kind of break this down by asset class, but the most attractive thing has been what I've already suggested, my exposure to lower middle market deals, and typically more lower than middle, where, often we're talking about mom and pop local businesses that just can't make the cut in this kind of an environment, and they're choosing this as an exit point, where, with some capital and some new management, you can expect to see some major revisions to profitability and also multiples on exit. So, I could go on about other asset classes, but nothing very surprising to say there.
Great. And Andriy, same question. I mean, what are you seeing change as far as, or what have you seen change over the past 6 months, and where do we go from here in the co-investment space?
Right. So we've done over 80 deals as a team through different cycles, and we invested through COVID, and we will continue to deploy capital, whether it's a second wave, third wave. We actually published a white paper on this topic, and it illustrated that GFC vintage funds and deals, in 2009 vintage funds, actually outperformed other vintages for 10-year periods starting in 2004. For various reasons, but the return dispersion is much higher, right? So ability to find and select the right asset is a critical element, as well as working with backable, sophisticated management teams, as well as GPs that deployed capital through cycles, and million sponsors, and know how to behave and how to navigate business in difficult times, right? So overall transaction volume for us is really up. We've done 8 deals, and we have a number of deals in diligence process that we expect to close, which is a higher number of deals than historical average for us. And on one hand, we see deal flow picked up on for GPs, and and different factors. Obviously, historical levels of dry powder, continued low interest environment, and on the other hand, we see situations where there is less co-invest capital available, right? There is less co-investors to execute on deals, and pre-COVID, there were groups that viewed co-investment as opportunity to allocate extra capital, so more like an opportunistic bucket on like a one-off basis, right? And those groups, I would say for the most part, kind of stay away on the sidelines and looking for kind of environment to go back to normal. And for us, it created interesting deal flow. Also, in terms of valuations, good question. It's a mixed bag, right? On one hand, we did see and we invested in deals at very attractive multiples, but we also see a trend where you have a technology company or the company that has a technology element within business model that continue to grow through COVID, in some cases benefited from COVID, and then multiples aren't going down for those businesses, right? And so just to give an example, one deal we paid less than 7 times for 30 million EBITDA business, 20+% margins, double-digit historical growth rate, high free cash flow, stable business, leading market position, and the company is growing through COVID, and it's amazing, less than 7 times. It wouldn't happen before COVID. And we have situations where a business, the lead sponsor did diligence before COVID. They agreed on the price. Company performed through COVID, so they couldn't renegotiate the price, right? Because there is no reason, right? And we felt like multiple was still high for the environment, and we managed to, as a co-investor, negotiate preferred structure where we get 15% PIK security with warrants and 1.8 times make-whole kind of payment protection. It's unheard of before COVID. So it's a mixed bag environment, and we trying to take advantage and continue to deploy capital. In terms of the diligence process, I mean, obviously more focused on downside protection, second wave of COVID. We do see, we have some preference to some sectors like healthcare, consumer staple sector, where business has some kind of technology angle, some logistics assets, but obviously the diligence calls are shifted to Zoom format, right? The deal sourcing is done through Zoom format. And also one of the critical elements for us is to meet management team. You have to meet management team as a co-investor at least once, no matter what. I mean, in person, right? And of 8 deals we've done, we had only one instance where one of my colleagues took initiative and flew to see a management team through first wave of COVID. But we shifted to Zoom, right? So because we had to, and we're trying to be creative how we do diligence.
That's certainly very interesting, and again, I think we're continuing. This is an example, right? Today's meetings are an example of the way things continue to shift online. And maybe before we pose the same question to Amir, I'll just ask if any of the other, Amir or Kurt, if you have had any particular challenges or experiences with meetings in particular, and how you're handling that sort of due diligence side of the process, considering how difficult it is to meet in person right now.
Well, for me, I just don't do it. It's an important part of my process, and we're just not at a point yet where extended face-to-face meetings inside offices are a wise choice. So, as I mentioned earlier, we'll get through this, but in the meantime, I'm kind of sticking with what I've already got and adding to it, not signing on with new managers, again, because my process isn't applicable.
Great. And Amir, if you want to comment on that point, I'll also, open it up to the broader question just about what you've been seeing over the past 6 months and how you're seeing things continue to change into 2021. Sure.
So several observations, some similar, some a bit different. So we actually made 3 new commitments in the second part of this year. If I look back to the relationships there, 2 of them we got to know pre-COVID, so started meeting them last year. And there's one where we got introduced to one of our investors who actually joined us for this particular opportunity. And Kurt, to your point, we ended up traveling to see them. We did not feel comfortable in making that commitment without that component. But I have to say, some of our process steps have become more efficient. So just as an example, we're getting to see more, and more of our team is getting to see more early. So whereas before we needed to kind of run schedules, people were out of town, traveling, it was hard to get those on the calendar and meet the teams all together. Now we're getting to see them up front and be able to kind of, have a conversation about what we feel about a particular opportunity. As we go further down the process, it's becoming more difficult in the sense of doing due diligence. You're right, Kurt, with a lack of information and track records like you have in Fund 5 and 6 on a fund is very different in an emerging manager. So that component is becoming more difficult. And like I said, eventually we don't feel comfortable in not, the relationship side is very important. We feel that when we anchor, we're not there to just anchor Fund 1, we're there to help them build a franchise. And that component is very, very important to us. On the opportunity set, mixed bag. We were looking at many distressed opportunities pre-COVID. We didn't have it in the portfolio, but we just didn't feel that the pricing and the timing and there's enough opportunity for these teams to be successful. Obviously, that changed in the COVID reality. We think markets are looking at various elements, but I think there's a real disconnect between what's happening out there in the public markets versus a lot of those other businesses that are not represented in the market and are going through very difficult times. And I don't think that's going away very soon. So 2 of the 3 that I mentioned are actually very different distress strategies that we committed to. And I think it augments kind of the rest of our portfolio on the buyout, on the growth and other positions that we have. So we are seeing opportunities. And we're all hopeful that this is going to end soon and we can get back to meeting people in person. It's a very important part of getting to know a manager from where we sit. So,
oh, great. This maybe we'll build onto this a little bit, because I think we sort of touched on some strategic questions, right, about how to position a portfolio in this time. And I just wanted to sort of dig a little bit further. I know we talked a bit about, what's going on as far as multiples and valuations, but and also a little bit about the distressed assets as well. We've certainly seen an increase in some distressed strategies, an increase in some trading strategies. I think maybe, the idea of trading equities has kind of become a little bit hotter, or the idea that there are inefficiencies in equities has become more enticing for investors. We've certainly also seen some opportunistic plays in the real estate space and hospitality. And I was just curious what your thoughts are about these types of broader strategic shifts going on, within technology, within other sectors, and how you are positioning yourselves.
Richard, who do you want to take it?
Amir, please, by all means, why don't you jump in on this one since you went last time?
Sure. I think we're dividing it into 2 groups, I guess. There's this tactical timing opportunity that's opened up because things are just kind of dislocated at the moment, and certain sectors are seeing price dislocation, which should revert back to kind of normality as things revert back to normality. But we're also looking at some sectors that are going to go through a fundamental change and as a derivative of what's happened. So certain elements in the consumer world are either going to accelerate a trend that has already been there and won't revert back to kind of what we had before COVID, or some business models are going to be just very different. And we're looking at that from a more longer term shift as opposed to these tactical market dislocation, which are kind of, there's a window there right now, but that won't kind of last. So I guess that's the way we're dividing it.
Andriy, any thoughts on the same strategic investments question?
Sure. I think, as I mentioned, I mean, obvious acceleration toward technology, particularly in consumer space where we have to have omni-channel business model, right, to be relevant and remain competitive and create value for investors, right? And obviously there are high-level sectors that less exposed to this environment in you know, over the long period of time, more than a year, let's say, right? Should be stable, kind of performing, like, you know, healthcare. We've seen some transportation, logistics, and markets that actually performed well through COVID. Obviously, consumer businesses with omni-channel models. Well, that said, our approach is kind of asset-specific underwriting, right? So it's a case by case. Let's say if we see a restaurant, and some people would say we won't do restaurant, we will take a closer look, right? And we did actually. We invested in a restaurant chain. It's a quick service concept that actually experienced a hit when COVID took off, March, April. But then it grew quickly and quickly adopted, and it's because of the business model, right? It's a grab and go business model. So there is no dine-in, right? So the company sells smoothies and sandwiches, right? So people would stop by, buy it, and leave, right? So and strong technology angle, right? They quickly shifted to online orders, curbside pickups, and the business is growing like so. Its historical same-store sales growth rate is 4%. After the COVID first hit, they grew over 10%. I mean, it's like a spectacular performance, right? We got comfortable. It was a fully priced deal, and you know, and the second wave COVID will even create more demand for this concept, because some of the restaurants that have dine-in, let's say that operate today at 50% capacity, might be closed, right? Also, like a curbside dine-in on the street, because it's going to get cold, won't be available, right? So there should be more demand for this type of services, right? So we have asset-specific underwriting, and you know, I think the most important element is, I mean, this is private equity, right? We don't bet on short-term swings for the business. We invest with a holding period 5 years or beyond, and I think the big question is, what is the new normal, right? When we go back to normal, I mean, how the company will perform eventually. Is it continue to benefit or from this e-commerce business or not, right? So something that we spend a lot of time in a diligence, sure.
And Andriy, are you of the view that at least these current trends in technology, that these are going to have some type of transformative effect over the long term? Do you think they're going to partially be incorporated, but will shift back a little bit? Where do you see those trends going?
I think, well, it all boils down to consumer behavior, right? And you know, you can find anecdotal evidence where, you know, 65-year-old consumer buys car online, and then he would tell you, well, I would never go to dealership to buy the car, right? Mm-hmm. So and it's anecdotal, but I think there will be some permanent shifts for sure. It's really hard to define them. I mean, I would probably speculate, but I think over a long period of time, there will be definitely shift to kind of online purchases, omni-channel business model. I think overall, like in the consumer market, we have a theme that high-end retail space, like a luxury, is more immune to e-commerce impact, right? Because people would still need to go to the store, touch, have experience, see the product, right? So I think that end of the market is more immune, but I think on average, yes, definitely big shifts. Ultimate outcomes, I mean, it's really hard to project.
Yeah. Kurt, any particular views as far as strategic shifts within the investment landscape itself?
Well, having been through a few volatile investment periods in the past, I've learned not to try to get on the right side of things in the short term, but rather to be thinking longer term. So yeah, strategic is the key term. The things that have been pretty well publicized, but still have a long way to go, are some of the things that Andriy was mentioning, which, related to e-commerce, work from home, areas that have been evident for a while, but where we've seen, several years of growth sort of compressed into less than 1 year, in ways that aren't going to reverse themselves. There really is a behavioral change out there that's been well documented by, visible public companies. So I think, we're still pretty early in these tech-related areas that really have been transformed by the pandemic. We've gotten exposure there through an investment in a VC accelerator that's basically seeding smart tech people all over the country that are developing technologies that are going to enable these things, and should be, at least some of them, acquisition targets by bigger companies, over the next few years. Also understanding that what we're enduring right now will be temporary. It's just the timing that's to be developed or to be determined. We have one significant public investment in a good turnaround play that's a fintech whose primary end market is vending machine operators. Obviously, they're suffering now, but that'll be a market that comes back nicely. This is also one of the activist situations that I mentioned earlier, where we managed to succeed in an activist battle about 6 months ago that brought in a whole new board and a whole new management team. So there's sort of a double whammy of end market improvement plus operational improvement that is an opportunity, at least partly created by COVID. So that's what's going on here.
Great. That's certainly very, very interesting insights, gentlemen. And I like the sort of macroeconomic picture that we're starting to get into here. I do want to shift. We've got election stuff to talk about. We've got plenty of interesting topics. Maybe just as a sort of shift in gears, maybe we can get into a little bit of sort of, product sort of specifics and, some details about the kind of structures that you're seeing out there before we kind of go further with some of these future developments questions. So maybe, Amir, maybe I'll ask you, as far as, investment structures, vehicles that you're seeing out there to invest in deals, are you seeing, do you have a particular preference, and what are your thoughts on, the use of funds and pooled vehicles versus just engaging in direct deals to execute investments? What are you sort of looking for right now? What do you think is working the best? Amir, I think you're muted.
I'm sorry, here you go. So yeah, our focus is exclusively on setting up funds and helping emerging managers set up their funds. Are the investors that invested in Gatewood and others that are joining us, I'm seeing more and more interest in co-invest rights as well. So that is an element that we're seeing, but not so much for ourselves, more so for the other investors. I think I did want to make a comment, though, to Kurt's point as well. One element that we've seen that was really important for us when this all started, but it trickles down to the funds we sponsored and also to their portfolio positions, is diversification. And diversification, it's kind of that lesson learned in other crises, whether it's the global financial crisis or before. And it's been, you're always surprised by how important it is. But I'll give you an example, and it's diversification across a client base, geographies. When certain markets were shut down, others opened up, and that enabled some of these companies to do better. Where we saw issues were where there was a customer concentration or a specific level of concentration in a painful kind of space, and that creates difficulty. So I think one of the takeaways from me is reinforcing this importance of diversification. And I'm glad that, the strategy we have inherently has that element, but again, it's important also all the way down to the single position level in terms of how they analyze the risk. To your point about co-invest versus vehicles, pooled vehicles, we're seeing, sponsors that do on a deal-by-deal basis. There's the benefits and costs of going each direction, but I think in this environment, having committed capital, able to transact and take advantage of market opportunity goes a long way. So I think in that sense, in this environment, and one of the reasons I think our model is working well at the moment is that LPs will find it difficult, to my previous point, to commit to new relationships in an environment like this. So an LP getting introduced to an existing relationships that already has a commitment to us, is one of our LPs, is being now introduced to a portfolio position. That's a very different conversation, and the ability to attract commitments in an environment like this, I think, is really important.
Thank you, Amir. And Kurt, any particular thoughts as well on that question as far as vehicles, direct deals? Are you primarily investing through funds? How are you handling those?
By number, the large majority of our investments are in funds. Having been a manager myself, I'm a big believer in the ability of smart, focused teams of people to, find opportunities that, you're not going to find as your own entity trying to do much more diversified things. So I'm, glad to pay the economics involved to benefit from the expertise of, like I said, smart, focused teams that, have expertise, sourcing advantages, et cetera. Now, that doesn't mean that there won't be direct opportunities. That's just not the primary thing that we're looking for, because the reality is that being a good direct investor is hard work. You have to look at so many deals to find a few good ones. And, that is something that requires, in my view, a large team to do effectively over an extended period of time. So, given that we're not, to put it mildly, on the large side of the organizational spectrum, I would much prefer to, leverage the expertise of others versus, focus on directs ourselves.
Great. Andriy, so obviously you focus on co-investments. I mean, same question to you. I mean, how are you seeing structural shifts or preferences in the way you invest, and are there any changes?
So we have a significant focus on portfolio construction. And our Fund 4, Fund 5, will have at least 20 investments, right? Fund 4 has 22 now, in a closing stage. Diversified by geography, obviously vintage. It's European, US deals, and we invested it through a 4-year period, starting in 2016. And the fund overall performed well so far. We have only one company in the red category, although it will not end up in bankruptcy, but it somewhat struggles. It's aircraft leasing business in Europe, right? And we are not specialists in any specific sector. We have some knowledge base, but we do look to partner with sector specialist sponsors, right? That they have specific angle in that specific asset class, and even further, their playbook that they executed in the past aligns well with specific assets. Either it's M&A, international expansion, organic growth initiatives like launch of new products, etc. Right? So we do that diligence very carefully, and all these elements help us to navigate COVID fairly well overall, right? And our focus will continue to have this diversified pool of capital approach. In terms of the co-invest structure, how we approach that, right? Typically, we invest in today's environment, and in generally speaking, we invest in LLC, and LLC is an entity that invests alongside a GP, right? Sometimes we see deals where we invest directly into the same vehicle as a lead sponsor, which creates less issues. But typically, as a co-investor, the key theme is we have to be fully aligned with the GP, right? So we have tag-along, drag-along rights, preemptive rights, information rights, disclosure rights, all these key elements at minimum, right? We start to ask more for specific rights as our equity or security type changes, right? So if you are less than 10% of equity, we will be passive co-investor, in fire and forget, right? And if we invest more than 10, we ask for observer rights. If it's 25%, we ask for a board seat, right? And if it's up to like 40 or even 50%, we will ask for specific rights on the board, like blocking abilities, exit rights, etc. Right? And it's a common equity. If we structure it as a preferred, it's a completely different animal, right? So we will structure it in a way that we have some protections, right, in terms of ability to exit and ability to block issuance of more senior security by the company, etc. So it depends on the asset class, but yeah, that's our approach.
Yeah, so it sounds like a lot of interesting structural considerations, Andriy, and appreciate all of your input on that. I want to shift gears again. We'll get into the election stuff as well in 2021. We have a question here. I just wanted to kind of pose that to the three of you as well, and feel free, any of you who want to take it. So the question is, how can new managers introduce you, either email, direct mail, etc., to create a professional relationship over a period of time? So I think that's just a question of, how are you forming relationships in this market? How can people get in touch? Do people email you with particular opportunities they see? How are you handling that now that, we're not sort of circulating in bigger, more personal contexts?
On my end, I mean, the best introduction of all is from another investor. Ideally somebody who's already done some vetting and ideally is actually invested. That is such a shortcut here. Conversely, unsolicited emails, there's just too many of them, especially ones that aren't compelling. And anyway, this is probably generalizable to most areas of business, but a smart introduction is far better than an unsolicited one. So, my ears are attuned to the former.
We have similar approach, but obviously my work email is publicly available on our website. So we welcome all sorts of inbound inquiries, either via email. Obviously, preferred route is to have new relationships introduced either to placement agent or through some kind of other referral. And I work on co-investments, and our approach is to, like if we get inbound inquiry about fund investment, I would more than happy to have a call, introduction call, and forward the email or connect with the right team member on primary side, secondary side, or even the lending side. So we are very much open to all the inquiries and happy to have our intro call and start developing relationships. I would say on co-investment side, let's say if it's a brand new relationship, we don't know lead partners, we would need to spend some time with them, right? We would have to meet them for sure, and see a couple of deals from them and do some reference checks, etc. And so it takes time for new relationships to develop, but the best way is to look at the deal together.
Not much different from my colleagues. We are very open to being approached. We all kind of look for the next deal and you don't know where it comes from. One of our partners is specifically the one kind of quarterbacking the effort, but everybody's channeling opportunities to him. I should say that a lot of the opportunities that we're seeing are through either our managers, which are referring us to their colleagues, or through other service providers. These events are a good kind of venue. If people are participating in these events and do a follow-up, and we participated, we want to get in touch, we'll always welcome an opportunity to have a chat. We like to monitor kind of people for a while. There's some deals that run very quickly because they're a more established kind of fund one that wants to institutionalize. They have a track record to look at, so we can process that more quickly. We have other situations where we incubated a team and helped them kind of form the right strategy and kind of the add team members for a year in our office. So it comes in all shapes and forms, but we're very open to getting introduced.
Great. I think this, we'll add one more audience question, because I think this kind of follows on in this sort of same vein of topic, but you know, when you're looking at potential opportunities, you have, when we talked about some strategic shifts that you guys are seeing, and things that you are, you know, looking out for from a business economic perspective, do you have preferences as far as minority control, majority control, when you're looking at particular deals? Andriy, why don't you go ahead?
Yeah, I can take this one. We typically do buyouts on the co-investment side, right? So lead sponsor drives the bus, fully in charge, and we invest as co-investor. Well, this year we did one growth stage deal. So the lead sponsor doesn't have full control, but they do have certain rights to impact business as needed, right? So we are open to do both, but obviously like growth stage deals are more tricky in terms of governance control. So getting to know management team is really important, making sure there is full alignment of interest in terms of exit, growth driver for the business, and all this important alignment elements have to be in place for us to get there.
Great. Amir or Kurt, any other thoughts on that?
Yeah, 3 elements for us really. Team, track record, which are kind of, you know, stating the obvious. But then the third point is differentiation. There needs to be something different and unique. You know, a buyout strategy, which is a me too. We do buyouts generally. It's hard for us to kind of, you know, get engaged, and our experience is that it's hard to kind of go out there and raise a new fund for a non-differentiated strategy. There needs to be something unique about the investment style, the sector focus, the value add kind of how they create value once they invest. So there needs to be some level of differentiation that we can buy into, and then tell the story to the outside world as well.
Here, I think it's similar to what Amir said. You know, we're mainly trying to find other people that are really good at something, not to have control of assets ourselves or control of operations ourselves.
Okay, great. And thanks to the audience for the questions. We'll shift now and start talking a little bit more about 2021. But if you do have other questions, please feel free to ask them. We'll try and allot, you know, a couple minutes towards the very end. I know we've got about 10 minutes left here. So for this question, you know, we talked a bit about COVID. We talked about some of the economic shifts. Obviously, 2020 election has been a big event. It continues to be a big ongoing event. I think hopefully we'll be at a, you know, that'll be resolved soon enough. And there are a number of items to sort of, and for investors to keep their eyes on. You know, obviously healthcare is a big issue, but so is energy and infrastructure. I think federal stimulus continues to have a huge effect on the market and certainly in tech strategies. So I'd just be interested in your thoughts about, you know, how the election is affecting your investments and investment strategies, how the stimulus might be affecting it, and how you see that continue to play out in 2021. So Kurt, why don't you go ahead and start?
Yeah, I mean, I think that, you know, what we got with the election and what we're likely to get after, you know, Georgia settled in January is really kind of a best case scenario for risk assets, namely, you know, divided government, you know, which means less likelihood of sweeping flawed policies. We will see stimulus of some level, you know, whether it's $1.5 trillion or $3 trillion, we'll see, but there'll be something incremental there that should, you know, should be positive again for risk assets. So I think it's, you know, a very favorable environment in a way that couldn't have been anticipated just a couple of weeks ago, at least not by those of us who believe polls have some predictive power. So, you know, the sectors you mentioned, Richard, I think, you know, one of the features of divided government, provided we get it, will be that, we will not see, these sweeping subsidies that we might have anticipated in the, in the green sector and a few other areas. I mean, certainly stimulus spending will be directed at infrastructure, so there are probably some, plays to be made there. But I think more than anything, under the likely structure we're going to see going forward, we should be thinking in terms of marginal changes, not the big changes we might have anticipated prior to the election.
Yeah, I think it's dead on. I think the public market is kind of echoing everything you said, Kurt. Right? And it's risk on. It's a good outcome. I think where my concern is not so much the short term or even depends on how you define your medium term, but it's kind of the debt at the federal level is a concern. And at the end of the day, that is either taken care of by inflation or by taxes or a combination thereof. So I think, in this interest rate environment, it's risk on. It's like you said, the market is kind of, liking the result and feeling that uncertainty has been taken away. So people are optimistic. But I think the concern I have is this kind of level of debt that needs to be eventually taken care of.
I'll just add a comment there. I mean, Amir, I think you're exactly right. The tricky thing, though, is that, the debt problem that no one wants to talk about, it isn't a question of the near-term issues of how big the stimulus is or whatever. I mean, I think our system's very good at dealing with short-term issues such as, through monetary policy or through fiscal policy. What we are terrible at is dealing with these longer-term issues as a function of our short election cycles, where the only good news in that story is that the real ugly scenario is still, a few decades away. And it has nothing to do with the short-term arbitrary decisions made by our governance. It's fueled by entitlement spending, Social Security and Medicare, which are not going to be easy problems to fix. Especially given that the only real available solution is substantial middle-class tax increases, which our system is not likely to implement. So I don't know where it all goes from here. I'm just glad that it's not a problem that is going to face a strong reckoning in the near term.
Yeah.
I think it's, in the short term, like next year, I think there is some level of uncertainty. Because there are many different variables that it's really hard to project how they will play out, right? On one hand, we have new vaccines with spectacular efficacy rate and ability to adapt to virus mutations, right? But on a different hand, well, we don't know how quickly they will be available, adoption rate. It's not fully clear magnitude of the second wave of COVID, potential economic lockdowns, right? And regardless who's going to take control of the Senate, which is, now it's a big theme for some of the media outlets, I think it will create this challenging environment for any administration to make drastic changes either in tax reform, regulation, because the least thing I would say that any administration want to do is to significantly change tax rates. Either it's a personal tax rate or corporate tax rate when you are in a recessionary environment, right? Where on contrary, you have to stimulate the economy rather than tax businesses, right? So I think next year is quite unpredictable. Potential volatility in capital markets. I think banks will be probably maybe more scrutinized, but it will be hard for banks to do new business. In today's environment, we see that banks typically lend to existing companies or to GPs that they know well. They are looking to partner with new and new kind of relationships, right? So I think there will be some interesting times next year, some uncertainty, volatility in cap markets, which should create some opportunities to invest at attractive valuations. But at the end of the day, who knows? No one has a crystal ball. It's really hard.
Yeah.
Today, it's really hard to make the short-term projections.
It is, and one of the things I sort of like to play around, and I think, Amir, you touched on a very interesting question, with, debt and where we're going. And it's interesting because obviously the government continues to issue so much debt, and we probably have effectively negative rates on most of that debt right now. And I think it was just in the news, China just had a major investment in Europe at negative effective rates, actual negative rates. So, and I wonder, if the Fed stimulus policy, if we're stuck in this world where we're going to kind of permanently be at low interest rates, if that can ever be unwound, what happens? Do you have, like you had years ago with that ticker tape tantrum? How does the market react? Are we sort of addicted to the juice, where, or we just kind of keep plowing through in this sort of risk-on environment and see how inflation and these other variables start to play in the markets?
Look, the component missing in the discussion is growth, right, and innovation, and it goes back to kind of whether the frontier can be pushed forward to allow for more growth to compensate for all of these other elements. Otherwise, this is gonna, it's a generation we can kick the can down the road, but we'll eventually need to deal with it. Now, I don't see that changing in the near term, to Kurt's point. But I think innovation and growth have always been the best way to deal with it, or the least painful way to deal with these issues.
I see we're running out of time. I'll give Kurt and Andriy, if you have any thought, a minute thought on that particular question before we wrap up. No additional thoughts?
Well, I think in terms of interest rate environment, obviously next year it will continue to be the same as it is today. It's hard to see Federal Reserve changing the policy even the following year, right? Because you need to see some growth, and as Amir said, we need some, improvement in productivity, right? GDP growth, but eventually I think we would have to get to this mean level of interest rate environment and start deleveraging, right? Because kicking can down the road will, it only amplifies problems in the future. So.
Excellent. Well, I want to thank the panel. I want to thank Kurt, Amir, and Andriy for your very insightful comments. I think it's been a pretty interesting discussion. And Lena, I'll hand it back over to you and help you, or let you direct traffic and where everybody should be going from here for the day.
Yeah, awesome. Thank you so much, Richard. And thank you, gentlemen, for your participation. To echo what Richard said, I think it was very insightful. So I hope the audience enjoyed the discussion as well. For those of you that are participating in our GPLP Deal Connect, you're going to want to log out of this link now and log into the separate link that my colleague Terrence Winters provided yesterday. We do have a couple more webinars coming up, so stay tuned for more information on those. Again, thank you to our panelists, Richard, our moderator, and to all of you for joining, of course, to our sponsors. We hope to see you soon. Until then, stay healthy and sane, and we'll see you soon. Take care.
Thanks, Dina. Thanks, Richard.
Thanks,